Adani Group, one of India's largest conglomerates, has been making headlines recently. The recent Adani share price crash has left many investors, particularly retail investors, bewildered and uncertain about the future of their investments. The company's share price has been on a downward spiral, leaving many retail investors scratching their heads and wondering what went wrong. However, a closer look at the situation reveals a more complex and nuanced picture. Everybody knows that Adani Group stocks has been falling for the past 5 weeks. Hindenburg Research, based in the United States, issued an unfavorable assessment on January 24th, which significantly impacted the behavior of the stock market in the country. Individual investors who bought these stocks at higher prices have suffered losses. The Chief Justice of India, D.Y. Chandrachud, raised a very important concern about the safety of Indian investors. He also raised concerns about avoiding such a situation in the future. To answer all these concerns, we must first understand stock markets. Buyers and sellers are required in stock markets. Buyers believe the price is too low and that it will rise, while sellers believe the price is too high and that it will decrease. Now consider the case of Adani Enterprises. From April through June 2020, stock prices increased. The majority of the shares were owned by foreign institutional investors. In March 2021, retail investors owned only 2.4% of the company, while promoters kept 74.9% of the business. This scenario has a very little free float and ownership concentration. On April 1st, 2020, the stock closed at 134. But by April 1st, 2021, retail ownership had risen to 1,106. However, on April 1st, 2022, it rose to 2,043 because LIC owned more stock. And on December 20, 2022, it reached an all-time high of 4,165. The retail investors who purchased shares were aware of the low free float, and some may have used this knowledge to anticipate price increases based on the expected average opinion. However, those who were not aware of this factor were also affected by the market forces that drove the price up. It means that some investors were trying to predict what others would do rather than basing their decisions on fundamental analysis. For investors, particularly retail investors, the Adani share price crash serves as a reminder of the importance of due diligence and risk management. Understanding the underlying factors driving stock market risk can help investors make more informed decisions and better navigate the ups and downs of the market. Individual greed, which drives the market, is beyond SEBI's control. Investors should be aware that a company with a limited free float can rise quickly but also fall quickly. The investment behavior of LIC requires more discussion. According to the stock exchange data, LIC owned 2.6% of Adani Enterprises in March 2017. It was reinvested 4 years later in April to June 2021. Adani Enterprises was extremely valuable at the time. LIC's purchases must have increased share prices due to the minimum free float. Finally, India's market regulator should verify the claims made in Hindenburg Research's report. Whatever the case may be, the truth must be revealed. As the Adani Group navigates these challenges, it is crucial for all investors, including retail investors, to stay informed and assess their risk tolerance before making any investment decisions. By understanding the underlying factors driving the Adani share price crash, investors can make more informed decisions and better navigate the ups and downs of the stock market.